Ready to start investing, but feeling lost in all the jargon? Stocks, bonds, index funds? Don't worry, you're not alone. Whether you're starting with just a few dollars or looking to build long-term wealth, this guide will help you make smart investment choices that grow your money over time. Stay tuned as we break down the basics of investing in a way that's simple, clear, and easy to follow. Investing can seem intimidating, but here's the truth. You don't need a lot of money to get started, and you don't have to be a financial expert. The sooner you start, the more your money will grow over time. In this video, we're going to break down the basic types of investments, stocks, bonds, mutual funds, and index funds, and show you how to get started with even just a few dollars. So, why should you invest? The short answer: it's the most effective way to grow your money over time. While saving in a bank account is important, the interest you earn there is typically very low, often less than 1% per year. On the other hand, when you invest in the stock market, your money has the potential to grow much faster. Historically, the stock market has returned an average of 7% to 10% per year, which can make a huge difference over time thanks to compound interest. By investing, you allow your money to work for you. And thanks to the power of compound interest, even small amounts invested consistently over time can turn into substantial wealth. Let's start with one of the most well-known investment options, stocks. When you buy a stock, you're essentially buying a small ownership stake in a company. This means you own a piece of that company's assets and earnings. Stocks are traded on exchanges like the New York Stock Exchange or NASDAQ, and the value of a stock can go up or down depending on how the company performs. The goal of investing in stocks is to buy low and sell high, meaning you want to purchase shares when they are undervalued and sell them when they are worth more. However, stocks can be volatile in the short term. This means the price can go up or down quickly, depending on market conditions, news, or company performance. The good news? Over the long term, the stock market tends to go up. That's why long-term investing is key. The more time your money is invested, the more time it has to grow and recover from any short-term dips. Next up are bonds. While stocks represent ownership in a company, bonds are essentially loans you make to governments or companies. When you buy a bond, you're lending your money in exchange for regular interest payments. Once the bond reaches its maturity date, you get back the original amount you invested, called the principal. Bonds are typically considered safer than stocks because they provide steady, predictable income. However, the potential returns are usually lower. The risk with bonds comes if the issuer, whether it's a company or a government, can't pay back the loan. But generally, bonds, especially government bonds, are seen as lower-risk investments. Bonds are a great way to balance your investment portfolio because they tend to be less volatile than stocks. They provide stability and can help protect your portfolio during times of stock market downturns. Now, if picking individual stocks or bonds feels too overwhelming, don't worry. There's a simpler option: mutual funds and index funds. Mutual funds pool money from many investors to buy a diversified mix of stocks, bonds, or other assets. By investing in a mutual fund, you get instant diversification, which reduces risk. One of the most popular types of mutual funds is an index fund. An index fund aims to track the performance of a specific market index, like the S&P 500. Instead of trying to pick individual stocks, you're investing in a fund that holds a little bit of every company in that index. This is a great option for beginners because it's low cost, diversified, and easy to manage. With index funds, you don't need to worry about picking winners and losers. You're simply investing in the overall market. Over time, this approach has been shown to deliver solid returns with minimal effort. Now, you might be thinking, I don't have thousands of dollars to start investing. But here's the great news. You don't need a lot of money to get started. Thanks to technology, there are many investment apps like Robinhood, Acorns, and Betterment that allow you to start investing with just a few dollars. One of the best strategies for new investors is called dollar cost averaging. This means you invest a fixed amount of money at regular intervals, like every month, no matter what the market is doing. Over time, this smooths out the highs and lows of the market, and you end up buying more shares when prices are low and fewer when prices are high. By consistently investing small amounts, you can build a significant portfolio over time. The key is to start early, stay consistent, and let compound interest do the heavy lifting. One of the most important principles of investing is diversification. Simply put, Diversification means spreading your money across different types of investments to reduce risk. If one investment performs poorly, the others can balance it out. This is why mutual funds and index funds are so popular. They automatically diversify your investments for you. The goal of diversification is to minimize risk while maximizing potential returns. Remember, it's not about putting all your eggs in one basket. A balanced portfolio will give you the best chance to grow your wealth over time, no matter what the market does in the short term. Before we wrap up, let's talk about some common mistakes new investors make. The first mistake, trying to time the market. No one can predict when the market will go up or down, so trying to buy at the perfect time is usually a losing game. Instead, focus on long-term growth and stick to your investment plan. Another mistake is panic selling during market downturns. It's natural to feel worried when you see your investments lose value. But remember, markets tend to recover over time. Stay calm, stick to your plan, and avoid selling out of fear. And finally, not diversifying. As we mentioned earlier, putting all your money into one stock or investment can be risky. Diversification helps protect you from losing too much in one bad investment. So always aim for a balanced portfolio. Investing doesn't have to be complicated or scary. By understanding the basics, stocks, bonds, index funds, and making small, consistent investments, you can build wealth over time and secure your financial future. The key is to start early, stay diversified, and let your money grow. If you found this video helpful, be sure to hit the like button, subscribe, and ring the bell for more personal finance tips. And let us know in the comments, what's your biggest question about investing? We'd love to hear from you.